Hi, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome back to our Beginner's Corner Information Series, second edition. In this video, we're going to go through Lesson 5, which involves calculations for stock and option selection. Now, once we've created our watch list of elite performing stocks eligible for option selling, we have to make sure that the options associated with those stocks meet our stated goal. In my case, I look to generate 2 to 4% a month for a near-the-money strike for my initial time value profit. In my mother's more conservative portfolio, my goal is lower, 1 to 2%. So in this particular lesson, we're going to go through how to do these calculations. Now, there are several calculations that are important in our investment decisions. First of all, the return on the option. Now we're talking about the time value component of the option premium. The intrinsic value component, you recall, for in-the-money strikes is not profit. The calculator that I'll be showing you soon will break that all down for us, so don't at all be concerned about the math. So the time value component must meet our stated goal. Now, when we sell an out-of-the-money strike higher than current market value, as an example, you bought a stock at 48 and sold at 50 call, there is a certain amount of upside potential, the stock moving from 48 up to the 50 strike. So how much more from a percentage vantage point will that represent? The third important calculation is downside protection. And that is for in-the-money strikes only. So how much protection do we have of the initial time value profit if we sell an in-the-money strike? Calculator will do that math for us. What is our break-even? The fourth important statistic. And in all cases, the break-even is the price of the stock at the time the trade was entered minus the entire premium. So the Ellman Calculator will provide all these essential calculations. And the main tab in the calculator that we're going to use is the multiple tab. You'll see that in action shortly, and I'll also show you how to get a free copy of the basic Ellman Calculator. All right, let's have a look at an options chain now. You saw one in an earlier lesson. This is a price list of option prices for a particular stock. In this case, we're looking at Alexion Pharmaceuticals. The ticker is ALXN, which at the time I made this screenshot was trading at 144.08. And this is a 6-week return. So if you wanted to annualize the returns you're going to see, you have to multiply it by 8.5. All right, so we look at the bid column when we look at options. We sell at the bid, the lower price. And if we were buying an option, we'd buy at the ask, the higher price. All right, let's start with the out of the money. It's a little bit easier, 150 strike. It's higher than current market value of 144.08. Now, if we look in the bid column, we see a bid price of 320 or $320 for the one contract. Now, you might look at the ask column and see an ask price of 410. Now, that's a spread where we can actually negotiate with the market makers, and that's beyond the scope of these basic lessons, but it's detailed in my books and DVDs, how we can get an even better price than 320. But we're going to look at 320 worst case scenario for our calculations for this particular video. Now, I also want to look at the 140 in the money strike, lower than current market value of 144.08. And that generates a bid price of 770. Now, we can't count that entire 770 as profit because we're going to lose 408 on the sale of the stock. So we must deduct 408 from the 770. Don't worry. The calculator will do all that math for us. So don't worry about the math at all. The key point here is that when we sell an in-the-money strike, the entire premium is not profit, just the time value component of that. But the intrinsic value, the 408, does represent downside protection. So let's look at the little snippet of the basic Ellman calculator and show you how all this works and fits into our option selling decisions. Once again, let's start with the out of the money 150 strike down here. Remember, the price was 144.08 and we generated worst case scenario 320. So when we look at the white cells, once the blue cells are populated, intrinsic value is 0 because it's an out of the money strike. Remember, intrinsic value only applies to in the money strikes. Upside potential is very, very important here. We have an opportunity for the stock to go from 144.08 up to that 150 strike. That's another $592 per contract, best case scenario. The break even, you recall, is the stock price minus the entire premium, which in this case is 140.88. Now let's get to the meat and potatoes of the math now. $320 on a cost basis of 14,408 represents a 2.2% 6-week return. That's about 20% annualized. But we also have an opportunity for 4.1% upside potential, meaning that our total possibility is 6.3%. That's over 50% annualized. So in a bull market, we could use an out of the money strike and have an opportunity for an unbelievable return. Okay, so let me just clear that out now, and let's go back and look at the in the money strike, which is a little trickier. Price of the stock was 144.08, and we're going to look at the 140 strike. So it's 408 in the money. The premium was 770, if you recall. Now we must deduct 408 from the 770. Here's the intrinsic value. There is intrinsic value because it's an in the money strike. Now there's no upside because no matter how high the price of the stock moves, we're required to sell at 140. So there's no upside, but there is an intrinsic value component which is going to play a role in the downside protection. All right, let's first start with the return on the option or the ROO, and that's 2.6%. So let me tell you how I got to that. We started with the 770, and then we deducted the intrinsic value. Okay, that divided by the strike price is 2.6%. That's our initial time value profit. If our goal was 2 to 4%, this would meet our goal. Now, once again, no opportunity for upside here because we're agreeing to sell at a lower price than current market value. But we do have the downside protection of 2.8%. That's different from break even. So here's what that means. We are guaranteed a 6-week return of 2.6% as long as share value does not decline by more than 2.8% by expiration of the contract. In a bear or volatile market, I would favor the in the money strike. Or perhaps your personal risk tolerance makes you sleep better at night having that insurance policy, which is paid for, by the way, by the option buyer, not by us. So how do we populate a covered call portfolio? Now, the stock selection process was based on the 3-pronged process: fundamental and technical analysis, and then common sense principles. We then must decide on the moneyness of the option, out of the money if you're more bullish or even in normal market conditions, in the money in bear and volatile market conditions. So are we going to go out of the money or are we going to go in the money? Then we must set a goal for our initial time value returns. So when we look at an options chain, we'll go higher if we're bullish, and we'll go lower if we're bearish, but either way, we must meet our initial time value return goal, which in my case is 2 to 4% a month. And that's how we select the option. It's kind of pretty easy once you get the hang of it. Now, the Ellman Calculator, I promise you a free copy. Go to that same link I told you about in a previous lesson for the file on banned stocks, the free resource link on the top black bar of our web pages. Put in your name and email, and you can download the calculator directly to your device. There's also a user guide that explains all the different tabs of the basic Ellman calculator, and of course all the other files that are in that link. So that ends lesson 5, calculations for stock and option selection. We're going to move on to lesson 6 next. I hope you enjoyed this lesson. And as always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.